Over the 2 years to March 2023, US inflation was a multiple of the FOMC's medium-term 2% target. Risks to the policy outlook were also heavily skewed to the upside. As supply-side inflation related to the pandemic dissipated, domestic pressures gave reason for concern. However, since March 2023, inflation pressures have slowly but surely abated. Indeed, while the FOMC continues to show caution, April and May's data point to balance between demand and supply and a near-term return to target inflation. The labour market is critical to the US policy debate, determining households' purchasing power and consequently demand-driven inflation pressures. Month-to-month, non-farm payrolls evidence resilience. The 230,000 per month average of the past 12 months materially lower than 2023 and 2022, but still ahead of population growth. However, growth in aggregate weekly hours worked has decelerated in line with non-farm payrolls, indicating supply is sufficient for demand. Payrolls may also not be telling the full story. Over the past 12 months, we have regularly highlighted that the other major US employment report, the Household Survey, has been materially weaker than non-farm payrolls, averaging a gain of just 31,000 per month, resulting in a slow drift up in the unemployment rate from 3.4% in April 2023 to 4% now. There is also growing evidence of consumption growth yielding to headwinds. After a strong 2023, nominal US retail sales effectively stalled over the first 4 months of 2024. Resilience in service demand has helped offset this weakness in goods spending, but total consumption growth has still seen a material step down from 2023. With the savings rate historically low and some evidence of financial stress evident, a further deceleration in consumer spending growth is to be expected. The weight of policy is also clear in April and May's CPI reports. Discretionary goods and services in the CPI basket have experienced significant disinflation or outright deflation over the past 6 to 12 months. Staples that have seen strong growth over the past year, such as motor vehicle insurance, also now look to be turning lower. Impressively, annual inflation for all components except shelter has averaged just 1.7% over the past 12 months, with the strongest reading over that period just 2.3%. While the case for rate cuts is being made, the FOMC's nervousness over inflation is unlikely to vanish, so policy easing is expected to be measured. The FOMC may currently only expect to deliver one cut in 2024, but as incoming data is incorporated into their views, we believe 2 cuts will be justified by year-end, the first in September and a second in Q4. We and the FOMC then see 1 cut per quarter through 2025 and the first half of 2026. Both the FOMC's end 2026 projection of 3.1% and our mid-2026 terminal of 3.375% are above the FOMC's longer-run neutral estimate of 2.8%. This signals a belief that inflation will remain a persistent tail risk for the US, and also the US labour market is expected to remain in good health. The enduring inflation risks the US face stem from the supply side. Recent US tariff decisions against Chinese goods will, all else equal, keep the price level for affected goods higher. Anecdotes around other forms of high-tech manufacturing in the US, like semiconductors, also point to cost overruns and difficulties in efficiently scaling new capacity. A more critical point for consumer inflation, though, is that the production of new housing remains constrained, not only by the cost of capital, but also by the availability of inputs. The longer there is an imbalance between inflation and growth, the more fragile potential growth will become, and the more susceptible the fiscal position will be to negative shocks. Risks for the US, therefore, do not end as inflation is brought to target. Instead, they evolve. This change will warrant continued, careful assessment. We'll see you next time.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.